In the realm of trading, patience is often spoken of as a virtue, but beneath this seemingly simple concept lies an intricate web of cognitive processes and psychological tendencies that govern how traders act or fail to act under pressure. At the heart of impulsive trading decisions is a deeply ingrained cognitive bias, the human brain's natural aversion to uncertainty and loss. When a trader stares at the flashing prices of a volatile market, what unfolds internally is not a rational evaluation of probabilities, but rather a biological and psychological struggle between fear, anticipation, and the illusion of control. Impulsivity in trading is not a random flaw in discipline. It is a predictable outcome of how the human mind evolved to respond to reward and risk. In evolutionary terms, immediate action in response to potential danger increased survival chances. The brain learned to favor quick reactions over careful deliberation when confronted with perceived threats. In the modern market context, the same circuitry fires when prices drop rapidly or surge unexpectedly. The trader interprets these fluctuations as emotional triggers, activating the fight or flight response. Instead of assessing risk-reward ratios or long-term probabilities, the mind becomes hijacked by a primal need to act, either to avoid loss or to seize what appears to be an opportunity slipping away. Loss aversion, a cornerstone concept in behavioral finance, explains why losses weigh heavier on the psyche than equivalent gains. Studies suggest that the pain of losing is roughly twice as psychologically intense as the pleasure of winning. This imbalance drives a subtle but powerful bias in trading behavior. When a trader sees a potential loss forming, even if the trade setup hasn't met their criteria, the mind rushes to intervene, convincing them that action is the only path to relief. The discomfort of uncertainty becomes unbearable, and impulsivity provides an escape. Acting even irrationally feels momentarily satisfying, because it replaces helplessness with the illusion of control. The illusion of control in turn fuels one of the most common traps in trading psychology, the belief that more frequent action equates to better results. The trader mistakes movement for progress, failing to recognize that markets are probabilistic systems, not machines that respond to effort. In this sense, impulsivity is not just an emotional issue, but a cognitive distortion. The mind overestimates its influence on random outcomes, interpreting every tick in price as a personal challenge to overcome. The more one trades impulsively, the more the brain reinforces the neural pathways that link uncertainty with action, creating a loop of dependency. Each impulsive trade temporarily reduces anxiety, strengthening the association between trading activity and emotional relief. Over time, this loop evolves into a habit, one that undermines the trader's ability to wait for the right moment. Fear of missing out, or FOMO, magnifies this bias. The modern trading environment, with its constant data streams, real-time alerts, and social media narratives, amplifies the sense that opportunity is always just out of reach. Every missed trade becomes a perceived failure. Every successful move by another trader becomes proof of personal inadequacy. FOMO exploits the brain's social comparison mechanisms, rooted in the evolutionary need to stay competitive within a group. In trading, this manifests as an anxious urgency to act before others do, to be in the market rather than risk being left behind. What FOMO conceals, however, is that missing a trade is not inherently a loss. It only becomes one in the trader's psychological interpretation. The cognitive bias behind impulsivity is further reinforced by the reward mechanisms of dopamine. Each time a trader takes a spontaneous trade and it results in a short-term profit, the brain releases dopamine, reinforcing the behavior. The trader experiences a burst of satisfaction not because the trade was rational, but because it gratified a psychological craving for immediate validation. This intermittent reinforcement, winning occasionally from impulsive trades, is the most dangerous kind of conditioning. It mirrors the same psychological mechanism that drives gambling addiction: unpredictable rewards that keep the mind hooked in anticipation. The trader begins to chase the feeling, not the process. Even when rational analysis warns against it, the emotional memory of previous lucky wins overrides logic. At this stage, trading becomes less about market probabilities and more about emotional self-regulation. The trader is no longer engaging with charts or price action as objective data, but as stimuli that provoke deeply personal responses. The mind creates narratives to justify these impulses. Thoughts such as "the market looks ready to move," "I don't want to miss this one," or "I'll just enter small and see what happens," are not strategic decisions. They are rationalizations crafted by the subconscious to legitimize emotional impulses. The language of self-deception becomes the trader's internal dialogue. The illusion of rational control masks the emotional chaos beneath the surface. Understanding this pattern requires awareness of how cognitive biases distort perception. Confirmation bias plays a crucial supporting role. Once a trader has acted impulsively, the mind seeks information to validate the decision. Ignoring contradictory data, this selective attention creates a false sense of confidence, even when the market is moving against them. The result is an emotional roller coaster of justification and regret. The more one trades impulsively, the more the feedback loop strengthens, embedding emotional decision-making into the trading routine. Breaking this cycle demands not only self-awareness, but also structural safeguards, trading plans, preset entry criteria, and journaling, designed to bypass emotional interference. One of the more subtle aspects of this cognitive trap is the way the human brain perceives time and effort. In most domains of life, effort produces progress. Study longer, train harder, work more, and results tend to follow. Trading defies this cause and effect expectation. The market does not reward the most active participant. It rewards the most patient observer. Yet the mind, conditioned by years of associating productivity with busyness, struggles to accept that waiting can be a form of productive action. This dissonance between psychological conditioning and market reality breeds impatience. When traders are inactive, they experience a form of cognitive dissonance, the uncomfortable tension between "I should be doing something" and "I must wait." To relieve this discomfort, impulsivity emerges as a coping mechanism. Cognitive biases also interact with the physiological state of the trader. Fatigue, stress, hunger, and lack of sleep impair the brain's executive functions, the very faculties responsible for patience, planning, and impulse control. In these compromised states, the amygdala becomes dominant, pushing the trader toward short-term emotional relief rather than long-term strategic thinking. Neuroscientific research shows that under stress, the prefrontal cortex, the brain's rational center, literally loses connectivity, reducing one's capacity for self-control. This is why traders who perform well in simulation or during calm markets can lose discipline in live conditions. The environment itself triggers the stress responses that activate impulsive tendencies. Another cognitive bias that shapes impulsive trading is recency bias, the tendency to give excessive weight to recent experiences over historical data. After a string of winning trades, traders become overconfident, interpreting recent success as evidence of personal skill rather than statistical variance. This inflated self-perception leads to premature entries, oversized positions, and disregard for risk management. Conversely, after losses, traders become hypersensitive to short-term fluctuations, interpreting normal market noise as potential danger or opportunity. In both cases, impulsivity thrives because the mind fixates on immediate emotional feedback instead of objective probability. What makes these biases so powerful is that they operate subconsciously. Traders often believe they are making rational decisions when, in reality, their choices are driven by unseen psychological forces. The market becomes a mirror reflecting one's internal state more than external conditions. Every trade is a projection of emotional tension, hope, fear, greed, or frustration, disguised as strategy. Recognizing this truth is unsettling, because it forces the trader to confront an uncomfortable reality. The greatest battle in trading is not against the market, but against one's own mind. The cognitive bias behind impulsivity reveals that patience is not simply a lack of action. It is a state of mastery over the emotional and cognitive mechanisms that drive premature decisions. To develop patience, one must first understand the origins of impulsivity. The brain's bias toward immediate gratification, its discomfort with uncertainty, and its constant search for control. Through mindfulness, structured routines, and an unwavering commitment to process over outcome, traders can begin to rewire these biases. But before any of that, they must recognize that impulsivity is not a character flaw. It is a predictable human response to a complex and uncertain environment, one that can only be transcended through self-awareness and deliberate psychological conditioning. In the intricate psychological landscape of trading, emotional regulation stands as the invisible boundary between discipline and chaos. Every trade is not merely a financial decision, but a confrontation with one's internal emotional architecture. The ability to delay gratification, to wait for the right setup, rather than surrender to the immediate thrill of entering a trade, distinguishes the consistently profitable trader from the impulsive one. Yet, this act of restraint requires more than discipline. It demands the mastery of emotional awareness, the taming of psychological impulses, and the reprogramming of the mind's relationship with uncertainty and reward. Emotional regulation begins with understanding that the markets are not inherently volatile. It is the human reaction to price movement that creates internal volatility. When traders watch candles rise and fall, the brain interprets this data not as neutral information, but as emotional stimuli. Each tick triggers chemical responses: dopamine during anticipation of gain, cortisol during fear of loss, and adrenaline when the market moves sharply in either direction. These hormones shape the trader's perception of reality, influencing decisions long before rational thought can intervene. The mind becomes a battlefield of competing impulses: hope versus fear, patience versus urgency. Emotional regulation, therefore, is not about eliminating emotion, but about managing its intensity and timing, ensuring that feelings do not dictate behavior before logic has a chance to speak. Delayed gratification in trading mirrors the famous psychological experiments that explored self-control. The marshmallow test, conducted by Walter Mischel in the 1960s, revealed that children who could resist eating a marshmallow in order to receive two later tended to achieve greater success in life. The essence of that study applies directly to trading. Those who can resist immediate action for a more favorable setup demonstrate the same psychological mechanism that underlies long-term success. The market constantly offers metaphorical marshmallows, small, enticing moves that tempt traders to jump in early. The untrained mind seeks to grasp them, craving the instant satisfaction of participation. The regulated mind waits, understanding that the real reward comes not from reacting, but from allowing probabilities to align before committing. This act of waiting, however, creates profound psychological discomfort. The human mind evolved to prefer certainty over ambiguity. Waiting introduces uncertainty, and uncertainty activates the brain's threat detection system. The amygdala interprets the absence of immediate action as vulnerability. In a market context, this triggers restlessness, anxiety, and the feeling that something must be done. Emotional regulation counteracts this primitive impulse by engaging the prefrontal cortex, the brain's executive control center, which governs rational thinking, planning, and inhibition. A trader who has developed emotional regulation can recognize the bodily sensations of anxiety, label them as temporary emotional responses, and resist the compulsion to act upon them. At its core, emotional regulation is about self-observation. Traders who can detach from their emotions develop a metacognitive awareness, the ability to think about their thoughts. This awareness creates space between stimulus and response, where rational decision-making can occur. When the market begins to move rapidly, the unregulated trader's mind collapses this space. The reaction is immediate, automatic, and emotionally charged. The regulated trader, in contrast, experiences the same emotions, but observes them without identification. This subtle psychological distance allows for a deliberate pause, where logic and risk management can re-enter the equation. The connection between emotional regulation and delayed gratification becomes especially clear when examining trading through the lens of behavioral conditioning. Every profitable trade reinforces a behavioral pattern. If profits are earned through impulsive entries, the brain learns that impatience leads to reward, strengthening the neural pathways associated with impulsivity. This creates a powerful feedback loop that undermines long-term discipline. Emotional regulation breaks this loop by introducing conscious control into the feedback process. The trader learns to associate reward not with the act of trading itself, but with adherence to process, the discipline of waiting, the satisfaction of following a plan, and the peace of mind that comes from control. To achieve this transformation, traders must reframe their relationship with reward. In the early stages of trading, the brain is conditioned to equate success with immediate profit. Over time, this association becomes toxic, as it reinforces a short-term focus. Emotional regulation shifts the definition of reward from making money to executing correctly. The gratification of following a plan, even if it leads to a small loss, replaces the fleeting satisfaction of a random win. This reframing activates a deeper level of psychological control because it aligns internal rewards with consistent behavior rather than external outcomes. The trader learns to celebrate patience itself rather than the emotional rush of quick results. This process of emotional reconditioning can be described as cognitive behavioral trading, the deliberate restructuring of thoughts, emotions, and behaviors through self-awareness and repetition. Traders must learn to identify emotional triggers, the excitement before entering a trade, the anxiety of watching a position fluctuate, the frustration of missing a move, or the euphoria of a quick gain. Each of these emotions, left unchecked, erodes patience. Emotional regulation requires confronting them without suppression. Suppressing emotions creates internal tension, which inevitably resurfaces in erratic trading behavior. True regulation acknowledges emotion, processes it, and then releases it without reaction. One of the most effective tools for developing emotional regulation is mindfulness. Mindfulness in trading is not about detachment from the market, but about engagement without reactivity. A mindful trader observes price movement, the way a scientist observes data, objectively, without personal attachment. This mental state reduces impulsivity by anchoring awareness in the present moment, preventing the mind from projecting fears or hopes into the future. Scientific studies have shown that mindfulness strengthens the prefrontal cortex and reduces amygdala activity, enhancing emotional control. In the trading context, this translates into the ability to remain calm during volatility, to endure drawdowns without panic, and to wait for setups without emotional strain. The concept of delayed gratification also extends beyond individual trades to the entire trading career. Many traders sabotage long-term growth by chasing short-term wins. They increase position sizes after small profits, abandon tested systems after temporary losses, or jump between strategies in search of faster results. This pattern reflects a deep-rooted impatience, a refusal to wait for the compounding effect of consistency. Emotional regulation combats this impatience by aligning one's sense of time with the realities of market cycles. Instead of viewing each trade as an isolated event, the emotionally regulated trader perceives it as a single instance within a much larger sequence. The focus shifts from winning this trade to executing the next 1,000 trades correctly. This long-term perspective transforms patience from a constraint into a strategy. Another dimension of emotional regulation is understanding the interplay between ego and emotion. The ego seeks validation through being right, while the market constantly challenges that need. When a trade goes against expectations, the ego interprets it as a personal attack, prompting defensive emotional reactions. Traders double down on losing positions, avoid taking stops, or seek revenge trades, all manifestations of ego-driven emotional dysregulation. Regulated traders, on the other hand, recognize that being wrong is not a threat to identity, but a statistical inevitability. By separating self-worth from outcomes, they preserve emotional stability even during drawdowns. This detachment enables delayed gratification because the mind no longer demands the immediate satisfaction of being right. It values the consistency of correct behavior instead. The practice of journaling serves as an essential bridge between awareness and regulation. Writing down thoughts, emotions, and behaviors after each trade externalizes internal processes, making them observable. Over time, patterns emerge: impulsive entries after boredom, revenge trades following losses, or hesitation after drawdowns. Recognizing these emotional patterns transforms abstract awareness into actionable insight. The act of journaling itself reinforces delayed gratification because it shifts focus from immediate results to reflective learning. It trains the brain to value introspection over reaction, cultivating patience as a byproduct of self-understanding. Physiological regulation also plays a significant role in emotional control. The mind and body are inseparable in the experience of emotion. Shallow breathing, tension in the shoulders, or a racing heartbeat are physical manifestations of emotional arousal. Regulating these bodily responses through controlled breathing, posture awareness, or brief meditative breaks creates a feedback effect that calms the mind. Neuroscience confirms that regulating the body's state can deactivate stress circuits in the brain, allowing rational thinking to re-emerge. In trading, where milliseconds of emotional reaction can lead to costly mistakes, such physiological awareness becomes an indispensable edge. Moreover, delayed gratification in trading mirrors the discipline of long-term investors, who understand that wealth accumulation follows exponential, not linear growth. Each patient decision compounds psychological stability. Every instance of emotional restraint strengthens neural connections associated with self-control. Over months and years, this creates a mental environment where patience becomes instinctive rather than forced. The trader no longer fights against impatience. They transcend it. Their sense of gratification becomes so delayed that it aligns with broader life goals, financial independence, mastery, and mental clarity, rather than momentary pleasure. In the modern era, where digital trading platforms offer instant access and dopamine-driven interfaces, the challenge of emotional regulation is greater than ever. Every notification, price alert, or social media post designed around market movement feeds into the trader's craving for stimulation. The constant exposure to market noise keeps the emotional system activated, eroding the capacity for stillness. To counter this, emotionally regulated traders design boundaries, specific hours of engagement, digital detox periods, and predetermined decision frameworks. These boundaries are not constraints, but tools for preserving clarity. They protect the trader's cognitive bandwidth, ensuring that emotional reserves are not depleted before important decisions. Delayed gratification, when mastered, transforms into a form of quiet confidence. The trader no longer measures worth by how quickly profits come, but by how consistently discipline is maintained. Emotional regulation becomes the invisible infrastructure that supports every strategic decision, allowing the trader to act without urgency, to observe without anxiety, and to wait without fear. It is through this mastery of emotion that patience ceases to be a forced behavior and becomes an effortless state of being, one in which the trader's mind and the market move in harmony rather than conflict. In the silent stretches between market entries lies the most overlooked battlefield in trading. The mind's war with time, waiting, though seemingly passive, engages some of the most complex neural mechanisms in the human brain. Beneath the surface of stillness, an entire system of emotional regulation, cognitive evaluation, and neural communication is at play. The neuroscience of waiting reveals that patience in trading is not merely a virtue or a skill. It is a neurophysiological achievement. To wait for the golden trade is to engage in a deliberate neurological process that counteracts millions of years of evolutionary conditioning that favor immediate action and instant gratification. At the core of this process is the dynamic relationship between two key regions of the brain, the prefrontal cortex and the amygdala. The prefrontal cortex, located just behind the forehead, is responsible for higher-order thinking, judgment, planning, decision-making, and impulse control. It is the brain's executive center, guiding rational choices and weighing probabilities. The amygdala, buried deep within the limbic system, is the emotional sentinel. It scans the environment for threats and opportunities, triggering responses of fear, excitement, or anxiety. In the context of trading, the amygdala interprets price volatility as emotional stimuli, while the prefrontal cortex attempts to analyze and plan strategically. Waiting, therefore, becomes a neurobiological tug-of-war between emotion and reason, instinct and intellect. When traders experience the tension of waiting for the right trade, what they are really experiencing is the amygdala's protest against inaction. Evolution shaped the human brain for survival, not for patience. In the wild, waiting could mean missed opportunities for food or safety. Action. Any action was evolutionarily advantageous. The modern trading environment, however, inverts this dynamic. The optimal behavior often involves restraint, observation, and delayed execution. Yet the amygdala continues to interpret inaction as danger. It releases stress hormones like cortisol and adrenaline, increasing heart rate and sharpening attention, as though inaction itself were a threat. The result is psychological restlessness, a feeling that one must do something, anything, to relieve the internal tension. Neuroscience explains that patience requires the suppression of the amygdala signals through the activation of the prefrontal cortex. This process is known as top-down regulation. The prefrontal cortex acts as a moderator, interpreting emotional impulses and deciding whether to act upon them. However, this system has limitations. Under stress, fatigue, or emotional strain, the prefrontal cortex's regulatory capacity diminishes. When this happens, the amygdala's influence grows stronger, and impulsive behavior increases. This is why traders often make poor decisions after long hours of screen time, or following a losing streak. The brain's rational control mechanisms are exhausted, allowing emotion to take over. The act of waiting, then, is not a passive endurance of time, but an active regulation of neurochemical processes. Each moment of patience strengthens the neural pathways associated with self-control. Neuroscientists describe this as neuroplasticity, the brain's ability to rewire itself based on repeated experiences. When traders consistently choose to wait for confirmed setups instead of reacting impulsively, they reinforce the circuits between the prefrontal cortex and the anterior cingulate cortex, a region involved in error detection and behavioral adjustment. Over time, this practice builds a kind of mental muscle memory. The trader's brain learns that calm observation, not reactive decision-making, leads to long-term reward. This rewiring process transforms patience from a struggle into an instinctive mode of operation. Dopamine, the brain's primary reward neurotransmitter, plays a pivotal role in the neuroscience of waiting. Most people associate dopamine with pleasure, but it is more accurately linked to motivation and anticipation. It drives the pursuit of reward, not necessarily its achievement. In trading, dopamine surges not when profits are realized, but when the brain anticipates a potential gain. This anticipation can become addictive, pushing traders to seek frequent engagement with the market, just to experience the dopamine rush. Waiting disrupts this reward cycle, depriving the brain of its habitual stimulation. The discomfort of waiting, therefore, is not just psychological. It is biochemical withdrawal. The trader's dopamine circuits, accustomed to constant engagement, react to stillness as a form of deprivation. The ability to wait for the golden trade requires the recalibration of this dopamine system. Instead of deriving reward from action, the trader must learn to derive reward from discipline itself. This is a profound neurological shift. It requires teaching the brain to associate dopamine release with patience, not participation. Through repetition and self-awareness, the act of waiting becomes its own source of satisfaction. Neuroimaging studies have shown that meditation, mindfulness, and focused breathing, techniques often used by disciplined traders, alter dopamine pathways in the brain, reducing impulsivity and increasing tolerance for delayed gratification. This transformation is not metaphorical. It is measurable at the neural level. Another crucial component of the neuroscience of waiting involves the brain's perception of time. The human mind does not experience time uniformly. Under emotional stress, time seems to accelerate during boredom. It drags. This subjective distortion of time perception is governed by the striatum and the insula, brain regions linked to reward expectation and interoceptive awareness, the sense of one's internal state. When a trader is waiting for a setup, these regions constantly evaluate how long it has been since the last rewarding event. The longer the wait, the stronger the brain's urge becomes to create a sense of reward artificially through taking premature trades, checking charts obsessively, or seeking stimulation elsewhere. To master patience, a trader must learn to normalize the brain's perception of time, to detach from the emotional narrative that waiting is wasted. Research in neuroscience also reveals the connection between patience and the brain's default mode network, DMN, a system that activates when the mind is at rest and not focused on external tasks. The DMN is responsible for introspection, imagination, and reflection. When traders are forced to wait, this network often activates, flooding the mind with thoughts, doubts, and scenarios. This can be productive or destructive depending on awareness. Uncontrolled, it leads to overthinking, second-guessing, and emotional agitation. Controlled, it fosters self-reflection, insight, and strategic clarity. The difference lies in how consciously the trader manages their mental dialogue during waiting periods. The neuroscience of waiting, therefore, emphasizes that stillness must be directed, not passive. A mind left idle becomes anxious. A mind guided inward becomes strategic. Patience is also tied to the brain's stress regulation systems, particularly the hypothalamic pituitary adrenal HPA axis. When traders face uncertainty, the HPA axis triggers the release of cortisol, preparing the body for potential threat. Chronic exposure to market stress without sufficient emotional recovery leads to elevated cortisol levels, impairing memory, decision-making, and impulse control. Neuroscientific evidence suggests that individuals who train their brains through practices like mindfulness or structured breaks exhibit lower baseline cortisol levels, allowing them to maintain calm focus even in high-pressure situations. Thus, the neuroscience of waiting is not just about tolerating time, it is about managing the body's physiological response to uncertainty over extended periods. The balance between anticipation and control is delicate. Anticipation activates the brain's reward circuits, but excessive anticipation can revert logical reasoning. When traders watch price movements, their brains simulate outcomes, visualizing profits, losses, and future scenarios. This mental simulation activates the same neural regions as actual experience, making imagined outcomes feel real. The more vivid the imagination, the stronger the emotional reaction. Neuroscientifically, this explains why waiting feels so intense. The brain is constantly simulating potential futures, each carrying emotional weight. To sustain patience, the trader must learn to interrupt this cycle of emotional visualization and return to present moment observation. Working memory, the short-term storage system for holding information, is another cognitive factor that influences waiting. The prefrontal cortex relies on working memory to maintain trading rules, setups, and risk parameters during decision-making. When emotional arousal increases, working memory capacity decreases. The brain prioritizes immediate emotional stimuli over abstract rules. This is why traders often abandon their strategies during volatile markets. They literally forget their plans in the heat of emotion. Enhancing working memory through deliberate practice, visualization, and repetition strengthens the neural networks that support consistent decision-making during prolonged waiting periods. Patience also has a profound connection to the neurotransmitter serotonin, often associated with mood stability and long-term satisfaction. Serotonin counterbalances dopamine's impulsive drive for immediate reward by promoting contentment and calmness. High serotonin levels correlate with greater tolerance for delay and improved emotional regulation. Traders who cultivate stable routines, maintain balanced nutrition, and prioritize rest often exhibit more consistent serotonin function, enhancing their capacity to wait without distress. The interplay between dopamine and serotonin defines the trader's emotional equilibrium, the constant tension between craving and contentment. Mastering this balance is essential for sustainable performance. The neuroscience of waiting reveals that the mental state of patience is not static, it is dynamic and tradable. Just as muscles grow stronger through resistance, neural pathways related to self-control strengthen through repeated acts of waiting. Each time a trader resists an impulsive trade, the prefrontal cortex gains greater influence over the limbic system. Over months and years, this neural strengthening manifests as calmness, clarity, and reduced emotional volatility. Waiting becomes effortless because the brain has adapted to the rhythm of restraint. The complexity of waiting also involves social and environmental factors. Neuroscientific studies on group behavior show that humans are influenced by mirror neurons, cells that activate when observing others' actions. In trading communities, watching others succeed or act impulsively can trigger the same neural responses as performing those actions oneself. This explains why exposure to market chatter, social media, or other traders' wins can erode patience. The brain subconsciously imitates observed behavior. To preserve the neurological integrity of patience, traders must control their sensory environment, minimizing exposure to emotionally charged or competitive stimuli that hijack the brain's reward circuitry. Furthermore, the act of waiting engages the insular cortex, the region of the brain responsible for interoception, the awareness of internal bodily states. Skilled traders develop heightened interoceptive awareness, recognizing subtle shifts in their physiological responses before they influence behavior. A racing pulse, tightening chest, or shallow breath becomes an early signal of emotional activation. By noticing these sensations, traders can intervene early, restoring balance through controlled breathing or short mental resets. This awareness bridges the gap between the conscious and subconscious mind, enabling a kind of embodied patience where the entire nervous system participates in the act of waiting. Ultimately, the neuroscience of waiting demonstrates that patience is not simply the absence of action, but the orchestration of multiple neural systems in harmony. It is the synchronization of emotion, cognition, and physiology in service of long-term strategy. Waiting engages the same brain regions involved in creativity, problem-solving, and resilience. It transforms the trader's neural architecture from reactive to reflective, from impulsive to intentional. In this sense, the golden trade isn't found through analysis alone. It is revealed through a brain disciplined enough to endure silence, strong enough to resist the pull of immediacy, and balanced enough to perceive opportunity without distortion. Within the psychological framework of trading, the illusion of control stands as one of the most deceptive and destructive cognitive distortions. It convinces traders that mastery over outcomes is achievable through effort, intuition, or superior intelligence, when in truth, markets remain fundamentally uncontrollable. The human brain, however, resists this reality. It is wired to find causality, to link events, to believe that every outcome is the result of something that can be predicted or influenced. This cognitive bias does not emerge from ignorance, but from an ancient psychological need for stability and coherence. In a world of uncertainty, believing in control provides emotional safety. Yet, in trading, this illusion can become the silent architect of ruin. The mind craves order, because it evolved in an environment where cause and effect were often clear. Touch fire, get burned. Hunt during daylight. Increase survival. This conditioning embedded in the brain, a fundamental bias, the belief that effort equals influence. The markets, however, are a system of probabilistic chaos. They operate beyond any single individual's will, driven by collective behavior, algorithms, and unforeseeable macroeconomic forces. Still, when traders win, their brains record the victory as personal achievement, reinforcing the idea that they had direct control. When they lose, they search for external reasons: bad data, manipulation, or bad luck, protecting their self-concept from randomness. This selective perception strengthens the illusion, turning trading into a psychological tug-of-war between ego and reality. The illusion of control is sustained by several intertwined biases. One of the most dominant is the control heuristic, the mental shortcut that assumes that more engagement, activity, or analysis equates to more influence over outcomes. In practice, traders who stare longer at charts, adjust indicators, or check the news obsessively feel they are managing risk, when in fact they are managing emotion. The sense of doing something alleviates anxiety, even if the action adds no value. This behavior resembles ritualistic thinking, where the act of performance itself provides psychological comfort, regardless of actual efficacy. Like a gambler blowing on dice before throwing, the trader refreshes screens, shifts stop losses, or tweaks strategies to feel safer in an unsafe environment. Neuroscience provides insight into this compulsion. The prefrontal cortex, responsible for planning and control, interacts with the dopaminergic system to reward perceived influence. When a trader performs an action that leads to a positive outcome, dopamine reinforces the connection between the action and the reward, even if the relationship was coincidental. Over time, the brain begins to overestimate the link between behavior and consequence. This neural reinforcement strengthens the illusion of control, embedding it as a deeply felt truth. Each instance of success becomes neurological evidence that control exists, while each failure is dismissed as an exception. The resulting cognitive dissonance traps traders in a cycle of over-engagement and emotional exhaustion. The illusion of control manifests in various subtle ways. One of the most common is overtrading. The trader believes that the more trades executed, the higher the probability of success. The logic seems sound at first glance. More opportunities equal more chances to profit. Yet, in reality, this mindset disregards probability distribution and position quality. The brain mistakes quantity for mastery, assuming that participation itself guarantees reward. Overtrading becomes a psychological substitute for patience. The trader feels in command, while the account quietly erodes. This illusion is self-reinforcing because sporadic wins fuel confidence, even when overall results decline. Each lucky trade serves as confirmation that control is working, masking the randomness underlying it. Another expression of this illusion appears in chart manipulation and technical overanalysis. Traders who constantly change timeframes, adjust indicators, or redraw trend lines are not refining strategy. They are negotiating with uncertainty. The mind seeks alignment between internal expectation and external reality. When the market doesn't conform to the expected pattern, the trader adjusts the visual representation until it feels coherent. This is a form of cognitive soothing, a way to impose structure on chaos. The satisfaction comes not from understanding the market, but from temporarily reducing the discomfort of ambiguity. The illusion of control thus becomes a self-administered sedative, a way to manage emotional unease rather than extract truth. The illusion also thrives on hindsight bias. After a trade closes, the brain reconstructs memory to fit the narrative of control. If the trade was successful, the trader recalls it as the result of foresight and skill. If it failed, the mind reframes the event as unpredictable or anomalous. This retrospective distortion prevents learning. True growth requires acknowledging randomness and error. But the illusion of control replaces humility with justification. Each justification fortifies the trader's belief in their predictive power, turning every experience into selective confirmation. Over time, this distorted memory structure builds a false sense of expertise. The trader feels more in control precisely when the market is proving otherwise. At a deeper psychological level, the illusion of control arises from a conflict between two human needs: the need for security and the need for agency. To feel secure, the mind must believe that the future is predictable. To feel empowered, it must believe that one's actions influence that future. Trading violates both simultaneously. The market is unpredictable, and individual influence is negligible. This creates cognitive tension, an unbearable psychological state that the brain resolves through illusion. By constructing narratives of cause and effect, the mind restores a sense of stability. It convinces itself that with enough analysis, discipline, or intuition, the chaos can be tamed. This belief, though comforting, detaches the trader from reality. The illusion of control also exploits the brain's tendency to misinterpret randomness. Humans are pattern-seeking creatures. The visual cortex and temporal lobe work together to identify patterns as a survival mechanism. Recognizing a predator's shape in the foliage, detecting repetition in environmental cues. In the market, this same mechanism identifies patterns where none exist. The brain finds meaning in noise, mistaking statistical coincidence for predictable structure. A trader sees a price move repeat twice and interprets it as a reliable pattern. Once this perceived pattern is confirmed by a successful outcome, even once, the belief solidifies. The illusion becomes encoded as knowledge, turning coincidence into confidence. The mind now operates not on objective data, but on subjective interpretation filtered through emotional validation. Risk perception plays a critical role in maintaining this illusion. The human brain underestimates the role of randomness in outcomes, because it processes probability emotionally rather than mathematically. When faced with risk, the amygdala activates, flooding the body with stress hormones that demand immediate resolution. To calm the emotional discomfort, the mind constructs rationalizations that restore a sense of predictability. This mechanism makes the trader feel safer but blinds them to reality. The illusion of control, therefore, is a neurological defense mechanism against fear. It replaces objective uncertainty with subjective certainty, allowing the trader to function under emotional pressure. The tragedy lies in its efficiency. The illusion works so well that it prevents the recognition of its own existence. The illusion of control also manifests in the relationship between traders and technology. Modern trading platforms, with their sleek interfaces, customizable tools, and instant execution, amplify the sense of agency. Every click, adjustment, and setting reinforces the perception of influence. The physical act of interacting with technology produces a tangible feedback loop Press a button, see a result. The trader feels empowered, yet the market remains indifferent. The interface gives the illusion of precision and mastery, masking the probabilistic nature of outcomes. Technology by design strengthens the neural circuits that equate control with interaction, deepening the psychological trap. The more tools a trader has, the greater the illusion that mastery is within reach. Emotionally, the illusion of control serves as a coping mechanism. It protects the ego from confronting the vastness of uncertainty. Admitting lack of control feels like surrender, and surrender conflicts with the self-image of a capable, intelligent, and disciplined individual. In trading, where identity often intertwines with performance, the ego depends on perceived competence for stability. The illusion of control maintains this stability by distorting perception. The trader believes they can shape outcomes, not because evidence supports it, but because the alternative, accepting randomness, threatens their psychological equilibrium. This internal defense mechanism turns into an invisible cage, where every action reinforces the illusion, and every failure deepens the need for control. Behavioral finance research has long demonstrated that traders who believe they have high control tend to take larger risks. This overconfidence stems from the illusion that skill can overcome uncertainty. Paradoxically, the more confident a trader becomes, the more exposed they are to randomness. This pattern mirrors what psychologists call the Dunning-Kruger effect. Individuals with limited understanding overestimate their competence. In trading, this translates into a dangerous spiral. Perceived control leads to risk-taking. Risk-taking leads to occasional reward. Reward reinforces the illusion, and the cycle perpetuates until reality intervenes with a loss severe enough to shatter the illusion. The aftermath often feels traumatic because it dismantles not just financial capital but the trader's sense of self. Cognitive neuroscience shows that breaking the illusion of control requires deliberate cognitive restructuring. The prefrontal cortex must learn to override the automatic associations that link effort with outcome. This process begins by reframing control itself, not as mastery over results, but as mastery over process. The trader cannot control the market, but they can control the conditions of participation, risk management, trade selection, emotional response. This reframing engages the anterior cingulate cortex, which mediates between conflict and adjustment. Each time a trader accepts uncertainty instead of fighting it, this neural region strengthens, reducing emotional reactivity. Over time, the illusion weakens, replaced by an acceptance of probabilistic reality. The illusion of control also influences group dynamics in trading communities. Collective discussion often amplifies confidence, creating a shared delusion of predictability. When a group of traders agree on a direction or setup, the brain's social circuitry activates, releasing oxytocin, the bonding hormone. This neurochemical response fosters trust and conformity, making the illusion socially reinforced. Group consensus feels like truth, even when based on emotion rather than data. The collective illusion becomes self-sustaining, providing psychological comfort through belonging. The danger lies in mistaking shared conviction for objective analysis. The brain equates social validation with accuracy, leading entire groups to act impulsively under the shared belief of control. From a physiological standpoint, the illusion of control provides temporary relief from the stress of uncertainty. It reduces cortisol levels, calming the body even as it clouds the mind. This biological feedback explains why it is so seductive. The comfort of believing in control produces measurable physiological stability, making the illusion feel not only emotionally satisfying, but physically soothing. Breaking this cycle requires building tolerance for discomfort, learning to remain calm without the need for certainty. This adaptation is a hallmark of psychological maturity in trading. The trader learns that emotional stability comes not from control, but from acceptance of lack thereof. The illusion of control ultimately shapes the trader's identity. It offers the comforting belief that success is the product of intellect and discipline, not chance. It allows traders to feel powerful in a domain where power is largely illusory. This belief can motivate, but it also blinds. The moment the trader equates control with competence, they lose sight of probability. They begin to measure worth by outcomes rather than adherence to process. The emotional highs of perceived control become addictive, the lows intolerable. The cycle continues until the trader learns that the only true control lies not in the market, but in the mind's response to it. In the world of trading, where uncertainty reigns and emotional turbulence is constant, psychological endurance is not merely a supportive trait. It is the foundation upon which all consistency is built. Many traders focus their energy on learning market structures, refining strategies, and studying indicators. Yet few invest in strengthening the mental framework that determines whether those strategies can be executed effectively under pressure. Building psychological endurance means developing the capacity to maintain clarity, discipline, and composure across thousands of hours of exposure to market stress. It is the invisible muscle that sustains focus when volatility spikes, when plans fail, and when doubt begins to whisper in the background. This endurance is not innate. It is cultivated through a deliberate process of conditioning the mind to remain stable amid instability. At the root of psychological endurance lies the understanding that trading is not a sprint, but a marathon of self-regulation. The market does not test intelligence as much as it tests emotional stamina. Every price movement, every small fluctuation, triggers internal feedback loops that can either strengthen or erode the trader's mental resilience. A sudden loss challenges one's sense of control, while a winning streak tempts arrogance and overconfidence. Both outcomes threaten balance. Building endurance means cultivating neutrality, a psychological state where wins and losses carry information but not emotional charge. To reach this point, traders must learn to view each trade as a data point within a broader system, not as a reflection of self-worth or intelligence. The mind is an energy system, and like all energy systems, it depletes over time when exposed to stress. Cognitive fatigue is one of the most underestimated threats in trading. Long hours in front of charts, the constant evaluation of probabilities, and the emotional strain of risk exposure drain mental resources. Neuroscience shows that the prefrontal cortex, the region responsible for decision-making and self-control, consumes significant glucose during sustained effort. When energy runs low, the brain defaults to emotional shortcuts and impulsive reactions. This is why traders who start their day disciplined often end it reckless, entering unplanned trades or abandoning risk parameters. Psychological endurance, therefore, begins with energy management. It requires understanding that the brain's capacity for rational thought is finite, and that endurance must be built through cycles of exertion and recovery. Recovery is as essential to endurance as effort. Just as an athlete trains the body through periods of intensity followed by rest, the trader must train the mind through cycles of focus and detachment. Continuous immersion in the market without adequate mental recovery leads to burnout, which manifests as emotional numbness, irritability, or compulsive behavior. Traders often misinterpret burnout as lack of discipline or motivation, when in truth, it is neurological exhaustion. Building endurance involves establishing structured routines that include deliberate breaks, reflection periods, and time away from charts. These moments allow neural pathways to consolidate learning, stabilize neurotransmitters, and restore emotional equilibrium. The mind, like muscle tissue, grows stronger in recovery, not in relentless strain. A core component of psychological endurance is adaptability. The markets are dynamic systems. Conditions shift, correlations break, volatility regimes change. The trader who cannot adapt psychologically is doomed to rigidity, clinging to old patterns even as the environment evolves. Adaptability arises from flexibility of thought, the ability to release attachment to outcome, ego, or identity. Many traders fall into mental paralysis because they define themselves by their strategy. When that strategy stops working, they interpret it as personal failure. Endurance means having the strength to detach from the need to be right and focus instead on remaining effective. The psychologically resilient trader adjusts approach without emotional collapse, viewing change as a natural part of growth, rather than a threat to competence. Central to the construction of endurance is the ability to tolerate discomfort. The market's natural rhythm is uncertainty. Discomfort is its language. Every meaningful trade carries risk, and risk activates the body's stress response. The brain releases cortisol and adrenaline, increasing alertness but also amplifying anxiety. Psychological endurance is the art of staying present within that discomfort without fleeing from it or overreacting to it. Most traders try to eliminate discomfort through control by perfecting strategy, overanalyzing data, or avoiding trades altogether. Yet endurance grows not by escaping discomfort, but by learning to coexist with it. It is the mental equivalent of holding a plank position. Strength is developed not by movement, but by sustained stillness under tension. A key psychological concept that underpins endurance is emotional granularity, the ability to identify and label emotions with precision. Instead of feeling a vague sense of stress or unease, the resilient trader distinguishes between anxiety, frustration, boredom, or anticipation. This nuanced awareness reduces emotional overwhelm by translating raw sensations into defined experiences. When emotions are named, they become manageable. When they remain undefined, they control behavior from the shadows. Building this kind of emotional vocabulary allows traders to respond intelligently rather than react instinctively. Over time, this self-awareness becomes automatic, forming an internal compass that guides decisions under pressure. The process of building endurance is inseparable from the development of consistency. Consistency in execution requires predictability of state, an internal environment stable enough to produce reliable decisions regardless of external chaos. This stability is cultivated through rituals and routines that signal the brain when to focus and when to relax. Pre-market preparation, journaling, meditation, and even physical exercise serve as anchors, grounding the trader's nervous system. Each repeated action builds neural pathways associated with focus and composure. These routines are not mere habits, they are forms of psychological conditioning. The mind, like the body, thrives on rhythm. Consistent ritual transforms discipline from effort into identity. A crucial pillar of endurance is self-compassion. Trading exposes individuals to constant judgment. Every loss feels like a reflection of inadequacy. The self-critical mind becomes its own worst enemy, turning natural setbacks into emotional wounds. Self-compassion does not mean complacency. It means recognizing that failure is an inevitable part of probabilistic environments. When traders respond to losses with shame or frustration, they deplete emotional energy needed for future performance. When they respond with curiosity and acceptance, they preserve that energy. The capacity to forgive oneself quickly after mistakes is a sign of advanced psychological endurance. It allows the trader to recover focus without carrying emotional residue from the past. Endurance also depends on the ability to sustain motivation through periods of stagnation. Unlike professions with predictable feedback cycles, trading often delivers delayed or inconsistent reinforcement. Weeks of disciplined behavior may yield no tangible results. The untrained mind perceives this as futility, leading to burnout or impulsive deviation from plan. The resilient mind interprets these quiet periods as training grounds for patience. This shift in interpretation is neurological as much as philosophical. By reframing lack of results as a phase of accumulation rather than failure, the brain's reward circuitry remains active, maintaining dopamine balance and motivation. In this way, endurance is sustained by meaning, the understanding that process has value even in the absence of immediate reward. The physiological aspect of endurance cannot be ignored. The body and mind form a single feedback system. Poor sleep, inadequate nutrition, and physical inactivity impair the brain's ability to regulate emotion and sustain attention. Cortisol levels rise, glucose metabolism falters, and neural efficiency declines. The trader's resilience deteriorates long before they realize it. Building endurance requires a holistic approach, regular exercise to release tension, proper hydration to maintain focus, balanced nutrition to support neurotransmitter function. These physical practices directly influence mental clarity. Stable body creates a stable mind, and stability is the essence of endurance. Another layer of psychological endurance involves developing temporal perspective, the ability to view performance across extended time horizons rather than single outcomes. Most emotional pain in trading arises from short-term focus. When traders judge themselves by the outcome of one trade or one day, they amplify emotional volatility. Viewing results through the lens of hundreds or thousands of trades transforms perspective. Losses become statistical noise rather than personal defeats. This long-term orientation rewires the brain's reward system, reducing emotional reactivity to short-term fluctuations. The mind learns to endure because it no longer demands immediate validation. It aligns with the natural rhythm of compounding. Slow, steady, cumulative. Cognitive reframing is another cornerstone of endurance. Every stressful event contains both a threat and an opportunity, and the way it is interpreted determines its psychological impact. When a trader views a losing streak as a catastrophe, the stress response escalates, narrowing perception and impairing decision-making. When the same streak is interpreted as data for improvement, the prefrontal cortex stays engaged, promoting adaptive learning. This reframing does not deny difficulty. It recontextualizes it. Endurance grows when adversity is integrated into purpose, rather than resisted as punishment. This shift transforms pressure into progress, turning emotional strain into a catalyst for resilience. Social and environmental factors also shape endurance. Isolation, a common feature of trading, amplifies emotional intensity. Without external feedback, internal narratives grow louder and more distorted. The mind begins to oscillate between overconfidence and self-doubt. Building endurance often requires establishing systems of accountability. Mentors, trading communities, or even structured self-review mechanisms. These external anchors serve as mirrors, reflecting reality back to the trader. When emotion clouds perception, interaction with other disciplined minds normalizes setbacks and reinforces balanced perspective. Endurance thrives in environments that promote shared learning over competition. Psychological endurance also demands mastery over boredom. The trading process includes long stretches of inactivity, where markets range aimlessly or setups fail to appear. Boredom triggers restlessness, leading to impulsive trades disguised as opportunities. The mind equates stillness with stagnation, craving stimulation to feel alive. Endurance means transforming boredom into a state of observation. It is in these silent periods that traders refine focus, analyze past performance, and cultivate presence. Boredom becomes a training ground for patience, teaching the mind to remain steady without external excitement. This ability to remain alert but unreactive distinguishes the mature trader from the compulsive one. The endurance mindset is fundamentally built on detachment from results. When a trader's emotional state depends on profit and loss, their endurance becomes hostage to randomness. Detachment does not mean apathy. It means emotional independence. It means executing a plan with full commitment, but accepting whatever outcome arises without internal disruption. Detachment converts discipline from an act of will into an act of trust. Trust in process, in probability, in one's capacity to remain grounded regardless of what unfolds. This psychological distance from outcome allows endurance to flourish because emotional energy is conserved rather than consumed by constant oscillation between elation and despair. Underlying all these elements is the principle of self-awareness. Psychological endurance begins and ends with knowing oneself. Every trader has unique emotional thresholds, cognitive tendencies, and motivational triggers. Some thrive under pressure. Others crumble under the same weight. Building endurance requires observing these patterns without judgment, understanding where energy leaks occur, and designing systems to counterbalance them. The self-aware trader does not rely on willpower alone. They engineer their environment and habits to support stability. They become architects of their own endurance, constructing a mental framework resilient enough to withstand the unpredictability of markets. Endurance, in essence, is the internalization of rhythm. It is the synchronization of effort, emotion, and recovery into a sustainable flow. The resilient trader does not chase control or perfection. They cultivate balance. Every setback becomes a repetition in the mental gym. Every challenge, a weight lifted in the strengthening of patience. Over time, endurance becomes less about surviving volatility and more about thriving within it. The mind ceases to fight the market's rhythm and instead moves in harmony with it, grounded, alert, and unshaken by the noise that once commanded its attention. In trading psychology, few ideas carry as much mythic weight as the concept of the golden trade, the perfect alignment of preparation, patience, and opportunity. To the untrained eye, the golden trade appears as luck, an accidental meeting of timing and market movement. But beneath the surface lies a profound psychological state, one born not of chance but of mastery over the self. The golden trade is not simply a trade that yields profit. It is a moment of convergence between disciplined thought, emotional balance, and perceptual clarity. It represents the culmination of countless hours of restraint, self-observation, and refinement. The trader who operates from the golden trade mindset is no longer reacting to markets, but harmonizing with them, acting from stillness rather than impulse. At the heart of this mindset is the understanding that opportunity is not created by the market. It is recognized by the mind. Two traders can observe the same chart, yet one sees chaos while the other perceives clarity. This difference arises not from knowledge but from the internal state through which perception flows. The human brain is not a passive receiver of information. It is an active filter, shaping what it sees through the lens of emotion, expectation, and belief. In the absence of mental clarity, the trader sees what they want to see, not what is. The golden trade mindset requires the dissolution of this distortion. It demands that the trader move beyond emotional bias and develop what psychologists call perceptual neutrality, a state where observation is uncolored by hope or fear. This neutrality is cultivated through mental conditioning. The golden trade does not emerge from overanalysis or the endless search for perfect setups. It arises from a mind trained to wait without anxiety and to act without hesitation. Waiting without anxiety is an act of mastery over uncertainty. It requires trust in one's system, but even more deeply, trust in oneself. The trader who waits is in constant dialogue with their instincts, learning to differentiate between intuition and impulse. Intuition is the subconscious recognition of patterns accumulated through experience. It speaks quietly, grounded in logic refined over time. Impulse, by contrast, is the amygdala's demand for immediate gratification. The golden trade mindset develops through the consistent practice of listening to the subtle voice of intuition and ignoring the seductive noise of impulse. Emotional balance forms the psychological foundation of the golden trade mindset. Every trade exists within an emotional spectrum: greed, fear, boredom, excitement, and each emotion, if unchecked, distorts perception. The disciplined trader recognizes emotions as signals, not instructions. They observe emotional arousal as a natural biological process, but they do not act upon it. When price accelerates and volatility rises, adrenaline floods the system, narrowing focus and amplifying urgency. The untrained trader interprets this physiological arousal as a call action, mistaking tension for opportunity. The trader with a golden trade mindset interprets the same signal differently. They recognize that heightened emotion indicates instability, not clarity. They understand that emotion, while inevitable, is not a compass. It is whether to be observed, not obeyed. To sustain this level of awareness, the mind must develop what psychologists call emotional elasticity, the ability to stretch under pressure and return to equilibrium quickly. Emotional elasticity ensures that wins and losses, both inevitable, do not alter the trader's mental state. When a trade succeeds, the golden mindset does not celebrate excessively. It simply acknowledges correct execution. When a trade fails, it does not despair. It examines, learns, and moves on. This detachment is not indifference. It is the result of integrating probability thinking into emotional life. The trader no longer experiences each outcome as a personal validation or rejection, but as one expression within a statistical sequence. Emotional elasticity transforms trading from a battlefield of identity into a process of observation and alignment. The golden trade mindset also reflects an advanced relationship with time. Ordinary traders view time linearly. They see opportunities as fleeting moments that must be seized before they vanish. The golden trade mindset sees time cyclically, recognizing that opportunities recur in patterns, not singularities. This temporal awareness dismantles the fear of missing out. The trader knows that missing one move does not mean loss. It means preservation of capital and focus for when alignment truly arrives. The perception of abundance replaces scarcity, and with it, the compulsive need to act disappears. The trader begins to wait not passively, but actively, in a state of readiness that merges patience with alertness. This balance, restful vigilance, is the psychological ground where the golden trade appears. The neuroscience of this mindset reveals how deeply it is rooted in the brain's architecture. The prefrontal cortex, responsible for executive function and decision-making, must dominate over the limbic system, which governs emotion and impulse. When the prefrontal cortex is active, it suppresses reactive tendencies, allowing for deliberate thought. The golden trade mindset is essentially a neurological hierarchy in proper alignment: reason guiding emotion, observation guiding reaction. This hierarchy, however, does not come naturally. It must be trained through repeated exposure to stress and the disciplined choice to remain composed. Each instance of waiting, each resisted impulse, strengthens the neural connections that sustain control. Over time, this rewiring transforms emotional volatility into stability, allowing clarity to emerge even under intense pressure. Psychologically, the golden trade represents the merging of focus and detachment. Focus is the narrowing of attention to the present moment, the exclusion of irrelevant stimuli. Detachment is the release of emotional ownership over outcomes. Together, they create a paradoxical state of deep engagement without fixation. In this state, the trader operates from flow, a term popularized by psychologist Mihaly Csikszentmihalyi, describing the mental condition where skill and challenge are perfectly balanced. The trader in flow experiences effortless awareness. Time slows, distractions vanish, and every movement feels synchronized with the market's rhythm. This is not a mystical experience, but a neurochemical reality. During flow, the brain releases dopamine, norepinephrine, and endorphins in precise balance, optimizing pattern recognition and decision speed. The golden trade often occurs within this flow state, where the mind's noise is silent and intuition operates with precision. To reach such equilibrium, the trader must undergo a psychological evolution from external to internal orientation. Early in their journey, traders focus outward on market signals, indicators, and news. They seek control through external knowledge. Over time, as experience deepens, they realize that mastery lies within, not without. The same setup that yields chaos for one trader yields clarity for another, because of the internal difference. The golden trade mindset arises when attention shifts from the external market to internal state management. The trader learns that self-observation is the most powerful form of analysis. Emotional neutrality becomes more valuable than any indicator, and discipline becomes the most reliable strategy. Developing this mindset also requires confronting and dissolving ego. The ego is the voice that seeks to prove, rather than to perform. It desires to be right, to predict the market, to be seen as skilled. Ego converts trading from observation into conflict. It transforms market movement into a personal narrative of victory and defeat. The golden trade mindset cannot coexist with ego, because ego thrives on attachment, while the golden state thrives on freedom. The ego-driven trader enters trades to validate identity. The disciplined trader enters only when conditions align, independent of self-image. This humility allows for flexibility, and flexibility is the hallmark of mastery. The trader becomes an instrument of adaptation, not assertion. The golden trade mindset also integrates risk as a natural element of existence, not as an adversary. Most traders treat risk as something to be conquered or avoided. They attempt to eliminate it through over-analysis or denial. The mature trader recognizes that risk is inseparable from opportunity, that both arise from the same uncertainty. Psychological endurance transforms fear of risk into respect for it. The golden mindset approaches each trade with reverence, understanding that loss is not failure, but tuition, the cost of participation in a probabilistic system. This acceptance dissolves anxiety because fear thrives on resistance. When the mind ceases to resist risk, it no longer experiences it as threat, but as an integral aspect of growth. Consistency within the golden trade mindset comes from process, not performance. The trader shifts identity from outcome-based to behavior-based metrics. Each day is judged not by profit or loss, but by adherence to structure, clarity of execution, and emotional balance. This shift redefines success as internal alignment rather than external result. The market becomes a mirror reflecting the trader's psychological state. Each fluctuation reveals where attachment or fear still exists. The golden mindset uses this reflection as feedback for inner refinement. Over time, the trader begins to measure progress, not in points gained but in moments of silence between thought and reaction. A significant part of this mindset involves creating mental spaciousness, the ability to hold multiple perspectives simultaneously without tension. The trader with this mental spaciousness can acknowledge conflicting data without emotional paralysis. They can see opportunity and risk together, uncertainty and clarity coexisting. This capacity for paradoxical thinking mirrors the nature of markets themselves. Complex, nonlinear, and often contradictory. The mind that can contain contradiction without collapsing into confusion becomes capable of seeing deeper order within apparent chaos. This expanded perception allows for nuanced decision-making, where the trader can act decisively without the illusion of certainty. The golden trade mindset also incorporates the principle of minimalism. Over time, the experienced trader removes complexity from their system rather than adding to it. They reduce the number of variables, indicators, and opinions until only what is essential remains. This simplicity reflects psychological maturity. Complexity is often a disguise for insecurity. The belief that more tools can provide more control. The golden mindset thrives on clarity and repetition. It relies on refined setups, clean charts, and predictable behaviors. This reduction of noise extends to the mind itself. A cluttered mind cannot perceive subtlety. A quiet mind can. When both the system and the self are simplified, alignment emerges naturally. Patience, within this mindset, is not passive waiting, but strategic preparation. It is the act of being ready without expectation. The trader who cultivates patience understands that markets move in cycles, and that opportunity arises when preparation meets timing. During waiting periods, the golden mindset focuses on self-improvement, reviewing trades, studying patterns, and maintaining physical and emotional well-being. The waiting becomes part of the process, not a void between trades. This approach transforms time into an ally rather than an enemy. The trader learns that every moment not spent trading can still be productive if it strengthens awareness or discipline. Discipline in the golden trade mindset is not a form of rigidity, but of harmony. It is not enforced through willpower, but expressed through identity. The trader no longer forces themselves to follow rules. They have become the kind of person who naturally follows them. This internalization of discipline marks the transition from conscious effort to unconscious competence. The trader does not resist temptation. Temptation simply loses its relevance. The energy once spent battling impulses is redirected toward observation and refinement. In this state, trading becomes art, fluid, measured, and effortless. The culmination of the golden trade mindset is self-transcendence. The trader begins to experience a sense of detachment not only from outcomes, but from self-reference. The act of trading transforms into an expression of awareness. The charts are no longer enemies to conquer, but landscapes to explore. Decisions emerge naturally, guided by intuition honed through experience. Success ceases to be an event and becomes a continuous state of presence. The trader's mind, once reactive and fragmented, becomes unified, calm amidst chaos, deliberate amidst noise, patient amidst uncertainty. The golden trade, then, is not merely a market event, but a reflection of inner harmony. It appears when the trader is no longer searching for it, because they have become the psychological embodiment of the patience, precision, and clarity required to see it. As the psychology of patience unfolds across the layers of trading consciousness, it becomes evident that the ultimate goal is not dominance over the market, but equilibrium within oneself. The equilibrium of mind and market represents the highest form of psychological maturity, a state where the trader's inner world reflects the same rhythm, unpredictability, and balance as the market itself. In this state, trading transcends mere strategy. It becomes a form of dialogue between human consciousness and an ever-shifting system of collective behavior. To reach this level, one must dismantle the illusion of separateness between self and market, recognizing that every reaction, every impulse, and every hesitation mirrors something within. The market does not punish or reward, it simply reflects. The disciplined trader sees in it a vast psychological mirror, each fluctuation revealing a hidden thought, a buried emotion, or an unexamined belief. The equilibrium of mind and market begins with surrender, not in the sense of giving up, but in the sense of yielding to the natural rhythm of uncertainty. The market cannot be controlled, but it can be understood. It cannot be predicted, but it can be observed. True equilibrium is achieved when the trader no longer seeks to impose personal will upon the market, but to harmonize action with its flow. This requires the cultivation of deep, perceptual awareness, a state in which every movement of price is perceived, not as an external event, but as part of a continuous interplay between order and chaos. When the trader releases attachment to prediction, they begin to operate through perception. Action arises naturally, without hesitation, because it emerges from clarity rather than compulsion. In this balanced state, time itself becomes fluid. The anxious mind perceives waiting as a burden, but the patient mind perceives it as preparation. The equilibrium mindset understands that each moment spent waiting refines emotional control, strengthens focus, and deepens understanding. The trader no longer rushes to participate. Instead, they observe as the rhythm of the market unfolds. In doing so, they discover that patience is not idleness. It is precision. It is the process through which the noise of emotion fades, and the signal of opportunity becomes audible. This shift from reactive time to reflective time is the psychological transformation that separates discipline from compulsion. The equilibrium of mind also involves the unification of intuition and logic. Intuition without structure leads to chaos. Logic without intuition leads to paralysis. The mature trader integrates both, understanding that intuition is not mystical, but the product of accumulated experience processed subconsciously. It is the brain's pattern recognition mechanism, operating faster than conscious thought. Yet intuition must be grounded in disciplined logic to prevent emotional contamination. The equilibrium mindset treats both faculties as partners. Intuition identifies possibilities, logic validates probabilities, and together they create decision-making grounded in both experience and reason. The trader's mind, once fragmented between emotion and analysis, becomes a singular instrument of awareness, functioning with coherence and unity. Equilibrium also manifests in the emotional body. Emotional neutrality does not mean emotional absence. It means emotional fluency, the ability to experience emotion without being dominated by it. Every emotion, from fear to euphoria, contains information about one's internal state. The resilient trader interprets these emotions, not as obstacles, but as data points. Fear signals exposure beyond tolerance. Greed reveals attachment outcome. Boredom indicates a lack of focus or purpose. When emotions are understood in this way, they cease to be enemies and become allies. The equilibrium of mind is emotional transparency, the clear recognition of feeling without the compulsion to act upon it. In this transparency, reaction transforms into reflection, and impulsivity transforms into intention. The relationship between self-discipline and freedom reaches its deepest expression at this level. In the beginning stages of trading, discipline feels restrictive, a set of rules designed to suppress instinct. But as mastery develops, discipline becomes liberating. It is the structure that enables flow, the framework that allows creativity to emerge without chaos. The trader no longer resists rules, they embody them effortlessly. Each act of discipline strengthens internal order, and this internal order reflects outward as external calm. The equilibrium trader experiences freedom not as the absence of structure, but as the mastery of it. In that mastery, effort dissolves into natural motion, and the process of trading becomes a form of meditation in action. The equilibrium of mind and market also requires acceptance of impermanence. The market is in constant motion, trends rise and fall, volatility expands and contracts. Certainty turns to confusion in moments. The trader who seeks permanence in such an environment suffers continuously, chasing stability in a domain defined by fluctuation. Psychological equilibrium emerges when one accepts impermanence not as a flaw, but as the essence of the market. This acceptance transforms uncertainty into rhythm. The trader no longer resists change. They flow with it, adjusting perspective and strategy fluidly. The mind, once rigid and anxious, becomes adaptable and serene. This adaptability is not passivity. It is awareness without resistance. Awareness itself becomes the central tool of the equilibrium mindset. The more aware the trader becomes of their internal processes, the less control emotion exerts over them. Awareness dissolves attachment because it illuminates the mechanisms of attachment. The trader who is aware of their own impatience cannot be enslaved by it. The act of observation weakens identification. Over time, awareness grows into self-transcendence, where the trader's sense of identity expands beyond individual trades, profits, or losses. They no longer perceive themselves as separate from the market, but as participants in a larger dynamic system of energy and behavior. This perspective breeds humility and wisdom, the twin pillars of longevity in trading psychology. Equilibrium also extends into lifestyle, for trading does not occur in isolation from life. The same mind that trades is the mind that lives, and imbalance in one inevitably affects the other. Nutrition, rest, relationships, and environment all feed into the trader's psychological state. A cluttered life breeds a cluttered mind. A stable routine nourishes clarity. The equilibrium mindset integrates holistic well-being into performance. Mental resilience is strengthened by physical vitality and emotional stability. The trader learns that success is not a single act, but a way of living, a continuous alignment of body, mind, and intention. When life and trading reflect the same internal coherence, endurance becomes effortless. The equilibrium of mind also transforms how traders perceive loss. In the early stages of development, loss feels personal, a wound to confidence and identity. But as awareness deepens, loss becomes information, a teacher disguised as pain. Each loss exposes a hidden bias, a psychological blind spot, or a lapse in discipline. The equilibrium trader receives loss without resistance, extracts the lesson, and releases the attachment. This relationship with loss defines maturity. It allows the trader to remain psychologically intact through drawdowns, market reversals, and the inevitable cycles of uncertainty. Resilience becomes natural because the ego is no longer threatened by outcome. The equilibrium mindset further dissolves the need for external validation. Many traders enter the markets seeking recognition, approval, or a sense of superiority. These motivations are emotional liabilities because they tether self-worth to performance. The equilibrium trader, grounded in internal stability, no longer measures value through comparison. The market ceases to be a proving ground and becomes a practice ground. This shift releases enormous psychological energy. Once consumed by competition, focus returns to refinement, and refinement breeds mastery. The trader's journey becomes less about winning and more about evolving, a continuous dialogue between self-awareness and skill expression. Finally, equilibrium leads to a profound redefinition of success. In conventional terms, success is accumulation of profit, status, or recognition. But in the psychology of patience, success is equilibrium itself. It is the ability to remain centered regardless of external fluctuations, to act decisively without emotional distortion, and to perceive clearly without attachment. When the mind reaches this point, every trade becomes an expression of presence rather than pursuit. Success is measured not in what is gained, but in what no longer disturbs one's peace. The golden trade becomes not an event, but a metaphor for the alignment of inner and outer worlds. The study of patience in trading is ultimately the study of consciousness itself. Every element, impulsivity, fear, greed, and discipline, emerges from the same source, the human mind attempting to navigate uncertainty. The trader's true opponent is never the market, but the unobserved mind reacting within it. Each phase of development, from the cognitive bias behind impulsivity to the cultivation of the golden trade mindset, reflects a gradual awakening, a movement from unconscious reaction to conscious response. What begins as an attempt to master strategy evolves into the deeper realization that mastery lies in self-awareness. Patience, in this light, is not passive endurance, but active alignment. It is the psychological bridge between chaos and clarity, emotion and logic, human fragility and mental strength. The patient trader embodies paradox: calm yet alert, detached yet engaged, disciplined yet flexible. This paradox is not contradiction. It is balance. The golden trade, then, is not a single moment of profitability, but a state of consciousness achieved when mind and market move in synchrony. It is the manifestation of psychological equilibrium through action. The evolution of a trader mirrors the evolution of the self. In the beginning, there is noise, the constant chatter of thought, the chaos of emotion, the hunger for control. As awareness deepens, that noise begins to quiet. Through loss and reflection, the trader learns to listen, not to the market's surface fluctuations, but to the silence beneath them. In that silence, they discover that the market was never the battlefield. It was the mirror all along. The journey of patience ends where it began, with the self. And in that realization, the trader no longer seeks the golden trade. They become